surveillance. He said good morning to all of you on the data front. It's simple. We're going to get to Mr. Mail and Watson in a moment. Your yields move and move with a vengeance. We were right out on the 10-year yield, 2.75%. Inversion.
All right. Good morning, everybody. Hopefully, y'all had a good weekend. This is going to be a short week, so kind of keep that in mind. We will be closed Friday, so plan accordingly. You can see that the 3 expirations a week for this week when it comes to the indexes, QQQ, SPY, Monday, Wednesday, and Thursday. It's always good to keep that in mind when you're looking at the weekly expected move, right? This thing plots out the high low of the implied volatility. And one of the things that I like to do with it is look at this week's high low in relation to last week's high low and ask the question, is it greater or smaller than the previous week? And you can see that it's just slightly smaller than the previous week, but the previous week was a full week, and this week is not going to be a full week. So the implied volatility is greater than it was last week, not less than it was last week, right? If we were putting a number on it, if last week was 78 points, we can just measure 175 points, and this week is 173 points. But last week was a 5-day week, and this week is a 4-day week, then the implied volatility is greater this week than it was last week. Confusingly simple, right? Another thing is I will not be in the office this afternoon, so just a little bit of a heads up. Going to be out of the house sometime past noon. So we got a wee bit of a wedge going on in the S&P. If we were to plot out bull bear targets, kind of contemplation of a 2% move on the day, up or down, the upside target would put us around 45.35, and the downside target would put us at 43.95. We are in that wedge that needs to be broke first. The economics, which normally we would go and look at, I guess we can go do this. Additional auctions at lunch. Those are going to be the game changers today, guys. This is where it comes into play. Do not be slipping today at 11:30 and at 1 o'clock. I can't tell you how many times I've seen a range-bound market suddenly rip and begin trending right at 11:30 or right at 1 o'clock when we have one of these additional auctions. So if we were trending all day, expect the trend to die because of these. If we've been range-bound, expect that to end and trend to begin because of these. These are game changers. Looking at the clock is one of the most valuable tools that you have as a trader, as an intraday trader. The clock is a game changer once you get used to keeping your eye on it. We are inside day, and at this point, we are IX10. We want to draw out some zones. So we got Globex low and Globex high. I really see this as like stage one, that we are likely to stay compressed within this range until the news comes out, and then we start moving around. We've got to absorb all of the news from the weekend and price it into the market. And I really believe that as that news starts to come in and get priced, we're going to leave this first zone. We actually want to take it up to the highest point of the Globex. When we opened Sunday night, we had a nice little pop up before falling down. So that's the high, 44.90 down to 44.50. It's a nice 40-point range, and there's plenty of room. We could spend the day there. I don't believe it. So if that's zone one, complete the rest of the range, and that would be the high of Friday and the low of our own Globex today. It's still a range bound market, and it's important to get this point across, because I've had people say, well, isn't this trend? Yes, that's trend. Well, isn't this trend? Yes, that's trend. I'm not saying that you can't see trend inside of a range day. You can always find trend. Trust me when I tell you that. You can always find trend. You can go to whatever time frame you want. A 10-second chart, you will find trend if you're looking for trend. But where is this day in relation to yesterday? If we're sitting inside of yesterday's price action and we have two candles that are side by side, we have two candles that look like this, but on a daily chart. Well, if you have day after day after day of candles sideways next to each other, that's not a trend. So the dominant thesis is that we're going to have a range day today. We're going to have a day that is inside of yesterday's day. Thank you for reminding me I didn't change that label. I had every intention to, and then I didn't. Appreciate that. Seen a squirrel, something shiny happened and went all ADD. Thank you. Thank you. All right. So dominant thesis is the range. This range is not just inside day, it's inside the previous day and inside the previous day. And that begins to form the IX10. The longer you stay in a range bound market, the more that you are inside the previous candle, the previous candle, the previous candle, you start to wind up more and more and more energy. One thing we learned from using that fractal energy indicator is how a market first gains energy and then spends that energy. So we learned that when a market is paused and going sideways, you can call it consolidation, you can call it basing patterns, topping patterns, rectangles. Yes, all of that is true, but what is it doing when it's sitting there sideways? Well, it's winding up more and more and more energy. If we were to turn on the fractal energy indicator, you'd see a really high gamma because of how long we've stayed sideways, just winding up this energy. So the market has the potential, it has the fuel to make an absolutely phenomenal move. There's no direction implied with that, right? Your your fuel tank on your car tells you you have a lot of fuel. It doesn't tell you which direction you're going. Think of the same thing with that fractal energy indicator. It's telling you if there is or isn't a lot of fuel, a lot of energy. And it's an interesting word that they use with that, because every other indicator talks about momentum, trend, inertia. It doesn't talk about energy. In the Thinkorswim Discord, I've shared the fractal energy indicator and 5 videos that I made that talk about it and pictures that go with it, demonstrating what the trade signals are when you're using it. So you can find that in the Thinkorswim Discord. Have at it. It works on any time frame, of course, because the markets are fractal. So dominant thesis will be the range-bound market. But what if we get rowdy? Well, if things were to turn bullish or if things were to turn bearish, then we've got our downside target 2%, 43.90, 43.95. That'd be our -2 to the downside. 45.35, 45.40 to the upside, 2% move from our current location or from right before I started streaming. We've moved since then, but it'll do. So if you're looking at that and you're thinking that's not 2% from the open, you're right. It's not. It was 2% from where I measured right before we started the Zoom. If we were going to go from the open, this is an issue that Thinkorswim has. Right now, it's very likely using Globex, not where we ended the day yesterday, Friday. $45.75 would be the upside 2% move from the close of yesterday. Do the same thing the other direction. Same spot. Take a look at the volume profile. What I want you to notice is all of this elevated volume here between 44.90 and 44.60. And we weren't able to make it through it. We moved around there in the overnight hours last night. We couldn't make it through this zone. We got a lot of trash there, just a whole collection of volume, but there's nothing there at that point, right? It has no structure, no validity, nothing that really stands out like a point of control or a value area. It's just a lot of resistance. There's a lot of orders going on right there. We are outside the box. We have every expectation when we are outside the box of a market moving to get back inside the box. But we want to pay particular attention to what is the market doing. Is it trying to get back in the box or is it moving away from the box? And right now, as you can see, we're moving farther away from the box. There is a critical level at our lows right now. That touch between, what was that, Wednesday and Thursday was just spot on perfect. It's kind of a commercial for being a pivot point trader. Like, why do we use pivot points? Because they work and they're so freaking awesome. But that level, that line in the sand right now is a very important level. So that's 44.45. If we happen to get through that, there's not much below there that's going to help us out. So when we zoom out a little bit, kind of look back and ask, is there anything around that can help us out? 4,400 is the next area down. So another 40 points below that low that we were just talking about. and that puts us into our bear target. The reason we just went through that is to be able to validate the lines and the levels that we're using. I had a 2% level marked down here. We have to have something more than just, well, the market likes to make 2% moves. It's true, the market does like to make 2% moves when it gets a little rowdy, but we need something more than that. By looking out on that 30-minute chart, we're able to look back and see that there's some price structure at the 4,400. It's also a major level, right? So major roundy psychological level. That would put us outside the expected move for the week, by the way, just to kind of keep that forefront in your mind. All right, we got a really muted range in the NASDAQ now that we've made a 1% move to the downside. So we've just basically been wound up since midnight, maybe a little bit later, a little earlier, maintaining this range outside of yesterday's price action. So right now we're in an inside day breakout. We were in an IX10 multiple days in a row, inside days. We're no longer in an IX10. We're on an inside day breakout. We have broken out to the downside. We're no longer inside of yesterday's price action, and we've already validated the breakout with a Busby play during the kill zone. Look at the range we had last week in the weekly expected move. Take that range and put it on this week's expected move, and you can see that not only are we in a shortened week with more volatility, but the range itself is actually bigger than last week's range that had 5 days. So remember on the ES, the range was just a little bit smaller, but we knew that it was more IV because it was a 4-day week. This range is even bigger than last week's range, and it's only a 4-day week. So this is a lot more volatility than the ES. Now, when it comes to volatility, the VIX is a volatility indicator for the S&P. You can use that to gauge the NASDAQ. You can, but the NASDAQ actually has its own volatility. So does the Russell. So if you wanted to use that volatility index, I don't use them enough to quote them off the top of my head, but on Tasty, they actually keep them listed in their watch lists. The VNQ is what I believe it is. Nope, that's absolutely not it. Volatility indexes. There it is. VXN. So if you wanted to see what's going on in the NASDAQ with its volatility gauge, this is a good way to go. It's a more accurate representation of the volatility within the NASDAQ. Now, if you've gone to my volatility school, you'll understand, hopefully, if I did a good job, you'll understand that the VIX isn't a real thing, right? It's a math formula based on options volume 30 days out in the SPX. So when you're looking at the VIX, you're really just looking at volume. You're looking at options volume. When you're looking at this, you're looking at the NDX options volume 30 days out. Same thing with the Russell. Now, when you start getting into other things like the VX9, the VIX 3-month, right, then everything starts leaning back into the futures itself. Especially if you're going to get into the VIX options. right? Remember that the options are not connected to the VIX chart. The options are connected to the VIX volatility futures. It's really the only thing we ever use that does that. Skew is on the rise. We kind of settled along those lows in mid-February, and we've been rising back up. It's kind of a gauge on the amount of money in the out of the money puts. Right now, that's been the swing trade. So we are starting to pick back up. So this morning we've got a fairly muted range. I would still use yesterday's high and today's low for my range gauge. You can break that down into two levels. So like zone 1 would be our own Globex high and the current Globex low. The rest of the zone would put us up to Friday's high. And then, of course, we would just use that for the entire IX10, pull it all the way back to last Wednesday. Without an absolutely amazing catalyst to the upside, I do not see a way that the NASDAQ is going to get to the top of that range today. That's a 3.36 move. It would be 0.75% more than the average ADR. And most of the day is done already, right? We're 12 hours into the game. So, for a bullish thesis, if we're going to make a move like that, it would have to be something critical, right? Like peace talks in the Russia-Ukraine situation or something like that, something really positive to galvanize this market. So it won't be subtle, it won't be soft or sneaky. It'll just be an absolute rip in one direction if we're going to make that kind of move. Doubtful, right? What we could do, and what's more likely, is that we get back up inside of that 3-day range, right? So the more likely scenario is that if we turn bullish, we're not right now, if we turn bullish and make that move back up, that we would just end up back inside the range. And that would be our upside move. The downside move really has us looking left and asking, well, what's down there? What's out there that can help us out? There's the roundy at 14,000. We're already down 1% on the day. If we were to make another 1% to the downside, that would get us really close. And I think close would get us there. Right. So 1 more percent would put us at 14,025. You take that quarter away, put us to the roundy. I really think if we get that close to the roundy, we're going to the roundy. So that would be our downside target. We still want to validate that, take it out, look at the volume profile, kind of ask the question, is there anything there? We do have some volume resistance, although relatively minor, at 14,200. So if we do happen to pull back up into that area, it's very likely going to be trouble getting through there. Keep in mind in this shortened week that the banks start earnings. They're not just going to start their earnings this week. They are going to set the tone and set the pace of earnings for this quarter, right? Well, for last quarter. For this reporting period, this cycle. If you didn't catch the news that had been coming out in the last few days, the Fed has made it really clear that their goal right now is to get this market to sell off. That's their goal. They want to get this market to sell off. They're looking for, I'll even use the phrase as it was said, the policy goal of the Fed right now is to lower the stock market to create a reverse wealth effect in an attempt to rein in inflation. So their goal right now is to knock this market down. Every time it starts to rally, every time it pops its up to the upside, they are going to come out with any kind of policy statements, anything that they can do in the media, do the tour, right? Do a full Ginsburg and use any kind of language that they can use to knock this market back down again. I didn't say it, right? It's not my opinion. So I shared the video where they talk about Bill Dudley, which is the former New York State Fed president. He said it. And the video for that is in the Bullish Bears Large Caps room. So we got the hedge play, gold breaking to the upside through the Globex this morning. We've got oil continuing that move to the downside, just kind of selling back off. You got the VIX and the dollar decoupled to a degree. We want to see this maintained. Think of the dollar right now as your global risk gauge, right? Our junk is better than somebody else's junk. When those fund managers can't go to cash because they're going to have to pay a significant fee to do that, if they can't go to cash, where are they going to go? Well, they'll just go to the dollar. The dollar's been more responsive to their angst, to their worries, than the VIX has been. The VIX has been really muted, almost scarily so. Right? It's like they're getting so complacent that they're not even messing with the VIX anymore. So keep your eye on the VIX and the dollar. We want to see that they do not begin to correlate. Speaking of correlation, I've said it before. When we have a highly correlated market state, it's a really, really dangerous situation. You right now need to be keenly aware of the advanced decline line through the day. Watch it very, very close. 70s and 80s, it's not a big deal. 80, 85, sure, no problem. We get above 90% correlated market state, and we're in a very critically dangerous situation. Not up or down either. It doesn't matter. If the market begins to correlate, get worried. Start tightening up your stops. Maybe look at your account and ask, what are you carrying right now that you don't need to carry? Be prepared to see some shock and awe and serious market movement. The index watch is a really easy way to see that correlated market state, right? Set it on, pick your index, the S&P 100, the NASDAQ 100. Just look at this thing. Issues are companies. There's 100 companies. So keep your eye on it. And if it gets above 90, 90 advancing, 90 declining, it doesn't really matter which direction. Be worried, be concerned. Well, the same thing goes with the dollar and the VIX. If these two start to unite and move in sync, be concerned, be worried. Last week, there was a lot of news articles about the global bond market just getting absolutely destroyed. So keep your eye on the bonds. We're breaking through some critical levels. It's getting a little bit extreme to the downside. I'm really thinking about coming in here and maybe selling some puts. But I'm going to be looking for a reversal first before I do that. But this kind of goes back to the Apple discussion that we had, when Apple was making that run to the upside. How many days in a row do you expect to get the same candle color before you start to get another candle color, the other one? All right, let's see what we got on the board today. It's a pretty squishy market this morning. We're down. We're not exaggerated down, just we're down a little bit. The markets are looking for direction. They don't really have anything to grasp a hold of yet. It's like a market waiting for a catalyst, basically. So gold back up underneath that $40 level, pressing against the high of the zone. So none of these other green ones look even remotely inviting at all. Let's see what's down instead of up. Got Bitcoin down nearly 4%, energy down 2%. Yeah, I'm going to leave that alone. Expanded technology down 1.25%. Emerging markets are down. Now we use that emerging markets for that global risk on, risk off sentiment. So when this is bid up, we're looking at a warm, fuzzy, happy global market that is ready for risk on situations. When it's down, just the opposite. They lost their mojo. They're not happy and warm and fuzzy. They're not ready to come in and put money to work. Communications is down still. It's been down. It's kind of like repeating the same thing over and over. Groundhog Day. Communications is down. Yeah, what else is new? Finance just slightly down. And with the banks reporting, we're going to see a lot of volatility in this. You don't have to play earnings directionally, trying to assume that you know what the company's going to report. You could just wait for the report to come out and then trade the response afterwards, right? Or to avoid the whole thing, if you know that banks are kicking off earnings season this week, rather than trying to trade individually named banks, you could just go in and trade the bank ETF. There's more than one, and you can get kind of specific with it depending on, if you want a regional bank ETF or just a broad finance ETF. The generic one, XLF, has things like JP Morgan, Bank of America, Wells Fargo, BlackRock, Morgan Stanley, Goldman Sachs, Citigroup. You see a lot of these names are sitting near the high of that range, right? Goldman Sachs chart looks very similar to Citi, to Berkshire, JP Morgan. I mean, those four charts, very, very close, very similar in their structure and makeup, and very similar at where price is at. Bank of America, on the other hand, is kind of the odd duck out at the moment. It doesn't look like any of its peers. BlackRock also not in any way looking like its peers. Go with a different kind of finance, KRE. We do this to kind of take a look around. What could we get a hold of? What's our expectations of an opportunity? I really think it's going to be energy today. I'd probably want to avoid finance unless you're ready to play the earnings. You're better off playing the energy. Energy, metals, mining, something like that. So for energy, it's not my style to go low from the lows. So all these names that are already down 1.5%, 2%, I wouldn't be trying to short them from the hole. Be looking for an opportunity to either go long in them or find them pulled back and then have an opportunity to join in and continue that move to the downside, right? So you can see XLE, nice little pullback. Well, if you get a more significant pullback, something closer to where we closed Friday, that wouldn't be so bad. All right, we're looking at the daily chart on the semiconductor ETF SMH, and you can see that we are gapped down outside of the Keltner channels at the moment, continuing to move farther away. There is a low down there around 237. It's a bit of a distance I don't expect to hit today, more on the low of the week. USO, another one that fits right in with energy. We are crossing through the 50-period daily moving average this morning. It's a really important number. That would be our first break through the 50-period moving average this year, if we close below it, and we haven't closed below it yet. So what I'm going to be watching for on USO is a trendline breakover, a 50-period bounce and a trendline breakover. Now, we tagged it the other day, April 7, and we rallied back off of it one more day, and we're coming back down and retested that, right? And this is kind of make or break on USO. We break below that 50, and I think we're going to come down and retest this previous pivot at 67, maybe 68. A trendline breakover, however, would be a bullish move to the upside with a price target starting at 77 and then 80 and 83. The really good thing is for that one, since we have that red candle and the bounce on the 50, is we'd be looking for a red to green play and a trendline breakover with an inside day breakout. I really like that setup. The Devil's Metal is up 2% this morning. Trendline breakover in its finest. We are back above the 20-period daily moving average. We broke through it in the current candle. 2350 is the upside resistance. So kind of want to get a feel for sectors that are not a part of the S&P, as some legacy sectors, the 11 legacy sectors of the S&P. We don't have a crypto sector, for an example. So we make the little homemade ETF list or names, make our own little generic ETF out of this. Remember that these names in the crypto list are companies that are heavily invested in the blockchain and or own a lot of coin. So, with Bitcoin being down this morning, not a surprise that most of these names are down this morning. But, kind of keep in mind some of the names that are in there, like NVIDIA. So we don't just look at NVIDIA and say, oh, it's the chip name. It's a part of the crypto list. And PayPal. Looking at the electric vehicles market this morning, the EV market, the entire sector and subsector and industry are all just getting hammered to the downside. Which wouldn't necessarily be a bad place to look today if we start to see that reversal in a couple of the sectors like energy, running energy off of those lows, running the EV market up off of those lows. I like that. That sounds pretty good. We don't have that reversal started right now, right? I'm in no way saying that we're going to go to the upside this morning. So don't go in trying to catch that falling knife. But I do like to approach things from a what's more likely perspective. You know, if we're down 2% and the news does not maintain this negative stance this morning, what's more likely that we continue to move another 2% to the downside or that we begin to retrace some of this negativity and at least get back towards flat? I think getting back towards flat is more likely. Looking at the pot stocks this morning, more down than up. So, not a lot of things out there, right? You got a little bit of retail, and then you've got your precious metals, and that's about it. Everything else is in flux. It's changing. It's either near its flat area or down significantly. So you want to approach with caution, maybe even revisit this same discussion as we get closer to the open. Keep in mind the clock is ticking. 11:30 and 1 o'clock today are going to be absolutely critical levels. Don't sleep on those levels. Don't let it surprise you at 11:30. Be absolutely ready to see this market rock and roll. Right. And the same thing at 1 o'clock. And I won't be in this afternoon. While we can trade mobile, I don't think that I will. It really just depends on, if I can. I don't know about the cell service where I'm going to be at. There are some names to the upside, guys. If you run your scan for the 52-week high, it'll get you pointed in the right direction. And you can see, it just kind of stands out. It's energy, consumer discretionary, consumer staples, and healthcare. So in the current market environment, play what's strong. There are names that you can get into. They're just not the sexy names that everybody focuses on all the time. And keep in mind, you want to be particular about the options that you trade, right? Make sure that these things are liquid enough. Just because they have weekly options does not necessarily guarantee that they're liquid enough. Now, I'm a little bit picky on that. But depending on what I'm trading, if I'm doing like a calendar or a diagonal, I'm not as particular about the liquidity when it comes to one of those kind of trades because you're really treating each leg individually, right? But trying to get a spread done when there's a lack of liquidity is a real difficult thing to do, right? Especially if you need to manage that trade and get it rolled or adjusted or in some way change it from its current form. So this is where we want to put our attention. It's where we want to put our focus if we're going to be swing trading, right? Focus on um, the sectors that lean into a bearish environment, right? When you look at the risk on, risk off sectors, top 3 sectors risk on, the bottom 3 risk off, and the 3 in the middle are like a midline, good in both conditions kind of situation. Well, look at the bottom ones, XLP, XLV, and XLU. We're looking at a daily chart, and we're looking at 3 different sectors breaking to new highs. And then you got energy also sitting right up there near the highs. Yeah, it's down this morning, but look at how close they are to their 52-week highs. Right? Same thing with building materials. It's not at the highs, but it's darn close to those highs. Way closer than something like the S&P and the NASDAQ. So we have a real cyclical low rotation going on, right? For the past decade, it's all been tech. It's been the shiny, sexy, glamorous names. It's very likely that that's going to be changing soon. You want to kind of get on the hunt for something other than that. Think about what was happening before the previous decade, before this tech boom. Because we're looking at a cyclical rotation. Still, there's plenty of names for swing trading. Just approach it with a little bit of caution. I've been using the diagonals and the calendars simply because you can hedge that individual call option or put option if you want to go short. You can hedge that a lot easier than you can protect it and defend it easier than you can a vertical spread, right? The only defense of a vertical spread is make it the size that you're willing to lose. I mean, all right, I get that, but it still implies you're going to lose. Whereas if you're just straight up buying a call or a put, and then you can defend that by selling short against that call or put, then you have the power and the capacity to individually protect each one of your trades. It's not perfect, but it still allows us to participate in the market beyond a binary choice of win and lose, right? If we just wanted the binary choice of winning and losing, we could just trade futures or trade stock. One of the good things about options is that we're stepping outside that boundary and we're not beholden to those restrictions. So just run your scan, 52-week highs, set it to something that matches your liquidity. For me, I've been using the weeklies, but you certainly could go in and run the liquidity list that we get from the CBOE. That's it, guys. I'll be streaming in the large cap or in the futures this morning, and I'll see you all there.